have record-breaking sales this month and still not be able to make payroll next Friday? See, a lot of business owners look at their profit and loss statement, they see a positive number and they think they're safe. But then they don't see that amount in their bank, and that can be so frustrating. So why is this? Because profit is an accounting concept, whereas cash flow is reality. In this video, I'm going to break down the different categories of cash flow with real-life examples so that by the end of it, you'll know what to look for in your own numbers so that your business survives and thrives. Hi, I'm Meeta. I have a background in finance and accounting. I spent over 10 years as a commercial lender, analyzing and approving loans for small business owners. And today I'm a business and property owner myself. So I have sat on both sides of the table. I know what banks are looking for, and I know the real life issues that business owners deal with. Let's start with a trap that almost every business owner falls into at some point. Say you own a landscaping company, and in June you completed $20,000 of work. Your expenses were $15,000. So that means you made a profit of $5,000, which is great. But your customers don't pay you for 60 days. And in the meantime, there's rent, payroll, fuel, and insurance, all of which have to get paid this month. So even though you're profitable, you don't really have the cash to cover your bills. And that is where the difference lies. Profit is the promise of money. Cash flow is the green paper sitting in your drawer. And that is why cash flow needs to be broken out into its own categories, separate from profit, so that you can get the real picture. The first and most important type of cash flow is operating cash flow, the heartbeat of your company. This is the cash your business generates or burns through during its normal everyday activities. It answers one question: can your business generate enough cash from its day-to-day activities without any outside help? Think of it as the air in your lungs. If your operating cash flow is negative for a long time, your business suffocates. So the takeaway is that a healthy business has to eventually generate positive operating cash flow. Because if you're constantly dipping into your personal funds just to keep the lights on, then you need to take a serious look at your pricing, your terms, and your expenses. Next is investing cash flow. This is cash spent or received on long-term assets. This could be property, vehicles, equipment, or investments in other businesses. For example, a construction company buys a new excavator for $90,000. That's an investing cash outflow. 5 years down the line, it sells it for $45,000. That's an investing cash inflow. Now, big purchases like this aren't necessarily a bad sign. They could mean that your business is growing. However, investing cash outflows do represent a shortfall in cash in the short term. And that is why they are worth tracking separately from your day-to-day business numbers. Is financing cash flows. This is money moving between your business and its lenders or owners. Taking out a loan or having an investor come in or an owner putting money in, these are all financing cash inflows. Now, paying down the loan, giving dividends, or an owner making withdrawals, these are all financing cash outflows. For example, you take out a $150,000 loan to open a second restaurant. That money is your financing cash inflow. However, as you pay down the loan over the next few years, that becomes a steady financing cash outflow. Now here's the important part. Financing cash flows can completely mask what's actually going on in your business. Here is a danger zone example. Picture a business owner who sees $100,000 in his bank account and feels great. They think that their business is finally turning around. But if you look closer at their core operations, you would see that they've lost $20,000. Their operating cash flow is actually negative. So what happened? The reason their bank balance grew by $100,000 is because they had taken a loan of $120,000. So this business is not thriving, it's surviving. And if they had not broken down cash flow into categories, they would not even know it. Now here's the number that really matters if you want to grow. Free cash flow. Free cash flow tells you how fast you can grow safely without having to take on outside loans. It's the real spendable number. Say you own a commercial cleaning service and this year your operating cash flow is $50,000, which is fantastic. But say two of your vans break down and your vacuums need upgrading, so you end up spending $40,000 in repairs and maintenance. So $10,000 is your free cash flow. The simplified formula is operating cash flow minus capital expenditures. So why do businesses run out of cash? See, a lot of businesses fail not because they are not making sales, but because they never separated out those numbers. So the common causes of cash flow trouble are customers paying late, buying too much inventory, growing too quickly, high debt payments, poor budgeting, unexpected expenses, and seasonal slow periods. Even genuinely successful growing businesses can run into cash flow trouble if they don't plan ahead for these. So how can you actually improve your cash flow? Here are a few practical habits that will make a real difference over time. Invoice promptly and follow up on anything overdue. Keep a close eye on expenses and cut what's necessary. Avoid overstocking inventory. Build a cash reserve for slower months. Review your cash flow every week or month so problems surface early. Negotiate longer payment terms with your suppliers when you can. And make it easy for your customers to pay you quickly. None of these are complicated, they just require you regularly looking at your numbers. So to recap, operating cash flow tells you if your core day-to-day business supports itself. Investing cash flow shows how much you're putting into long-term growth. Financing cash flow shows how you're funding the business, your own engine or borrowed money. And free cash flow tells you what's truly left over to pay yourself, pay down debt or reinvest. Don't just glance at your bank balance, pull apart these numbers. If your operating cash flow is negative, that's the first leak you need to fix, no matter how good your bank balance looks. So cash flow is the lifeblood of any business, and you don't need to be an accountant to manage it well. You need to know where the money is coming from, where it is going, and to look ahead instead of just looking at your bank balance today. And if you're looking for an easy way to track your numbers, I've created a spreadsheet specifically for small business owners. It's super easy to use. You don't need to be an accountant or bookkeeper to use it. Just download it and start using it from the get-go. There's no setting up of accounts, no time wasting. Plus, you get my support if you have any bookkeeping or spreadsheet questions. So take a look at this demo where I show how easy it is to use it.